have 7 operational properties currently, which are offering over 5,000 beds in student accommodation, making us arguably one of the largest operator of real estate in Africa. Typically, capital markets is the playground of institutional or sophisticated high net worth individuals in a market like Kenya. But we've always felt that the real potential lies with the everyday Joe, right? If you look at developed markets, it's by bringing in retail investors that they've been able to actually fuel their growth, right? Essentially, what we've created is like this virtuous self-financing cycle. The D-REIT is the one that buys land, constructs a property, and then once it becomes operationalized, it is available or eligible for acquisition by the income REIT. And the I-REIT, from the proceeds that it pays to the D-REIT for acquiring a developed asset, an operational asset, the D-REIT can then proceed to develop more. My name's Raghav Gandhi. I'm the Managing Director for Acorn Investment Management Limited, which is a licensed REIT management company based out here in Kenya. I also dual serve as the Chief Investment Officer for Acorn Holdings, which is the parent company. So our business model is predicated around providing affordable, quality rental housing, specifically to the young people in Kenya. And we started in that strategic direction by providing purpose-built student accommodation to the students of Nairobi. Acorn is an integrated real estate developer, probably one of the few on the continent in Africa, actually. And what I mean by an integrated real estate developer is that it manages the full value chain for a real estate business. We have a development management arm responsible for managing projects on time, within budget, with quality and safety. We currently have 6 projects that are under development. A couple of projects that will be delivered next year in 2023, and then the 4 other projects, they'll be delivered during the course of 2024 and 2025. We also have a property management arm operating the developed projects on a day-to-day basis. We have 7 operational properties currently. We're offering over 5,000 beds in student accommodation, making us arguably one of the largest operator of real estate in Africa. And then lastly, we have an investment management company as well, Acorn Investment Management Limited, which is what I head. At the start of 2021, we launched a couple of REITs focus on investments in purpose-built student accommodation. Through the REITs, we're managing close to about $100 million worth of assets. Typically in Africa, most developers don't look to hold on to real estate. They sell apartments. That's obviously been one of the challenges, because in order to be able to follow that business model, you need to have access to patient capital.
In terms of like the typology, when you're talking about purpose-built student accommodations, that's different than a general apartment because it's sort of more of a dormitory format.
We've got actually 2 different product offerings. So one is what we call a Kwetu. It's an accommodation offering that is targeted more towards middle income to upper middle income students, or students from upper middle income families. Rental range, I'll convert it into dollars, between $160 to $300 per month. And then we've got another product offering, the first one we've just launched, which is quite exciting because that's really within the mass market affordable segment, and it's called Kejani. For Kejani, the price range is about $80 to $120. Kwetu is based around having your own ensuite bathroom, and we give you a small kitchenette as well within the unit. So typically the room sizes range from about 12 to 16 square meters. Mostly they're around single sharing, but we do also have a number of rooms which are twin sharing. So what we have is a partition in the middle. That's the lower end of that rental range spectrum for Kwetu. In the case of Kejani, it's much more dormitory style living. It's shared rooms, either between double and quadruple. The facilities are shared within a floor segment. So a corridor will have at the end of it the bathroom, the washroom space, a kitchen area for if you want to cook for yourself. Otherwise, we also provide a cafeteria. Aside from the room, one thing that they all have in common is what really makes this student accommodation versus regular apartment living is we provide lobbies, we provide terrace space where students can hang out, a lot of common area space. We organize events, so provide study rooms for them to kind of get together for group study sessions. We have a gym area. So it's all these other facilities that then are, make it a conducive environment for happy student living. In terms of the buildings themselves, they're very similar. Sometimes the height differs a little bit, or the building footprint might be a little bigger, but in terms of look and feel, very much now the product has been refined. And I think that's been a journey over the last 5 years. So if you look at the more recent projects, they are very different from the first two projects in terms of kind of room composition, room mix, and so forth. But that's part of learning, and that's where we've got to. So Acorn's been through quite an interesting journey. Actually, as an organization, it's now over 20 years old. In its previous guise, it was originally named Consultia, set up as a project management consulting firm, founded by a gentleman called Edward Kirathe. This was in 2001. He was able to gain the confidence of a number of institutions across East Africa to help manage a number of projects for them. In 2006, he ventured into developing for himself as well. So doing joint development deals, tying up with landowners. He would provide the development management expertise to deliver the project. And actually, it was at that time in 2006 that the name was brought in called Acorn. His vision was always about growing something with a strong foundation of a far reach, doing these kind of opportunistic investments across different asset classes, whether it be commercial, whether it be industrial, whether it be retail, residential, and so forth. So sector agnostic. In 2015, Acorn received an investment from Helios. Helios is a leading Africa-focused private equity firm. They became partners in Acorn Holdings Limited. And at that time, there was a strategic review and a decision taken to look to build something that was sustainable and scalable, right? Because ultimately, that's what private equity does. It wants to invest in something that has a visible growth opportunity. There was an extensive market research study that was done to identify where were demand-supply gaps in housing. And what was identified was the opportunity to provide affordable rental housing in Africa, and starting off with Kenya. Providing affordable, quality, safe, sustainable housing solutions started with the journey of purpose-built student accommodation. Unlike the trap that a lot of developers and real estate players fall into, where they go on the basis of a hunch or a gut feel, Acorn's business model is very much based around statistical data-driven analysis. Research pointed to the fact that potential addressable demand just for those two products of 110,000 beds. That's the market size for the Kwetu and Kijani offerings at the price point. So it's specific to what we're offering. The overall population of the university students in Kenya is 550,000, right? So it's even a much larger space. Nairobi's around, I would say somewhere between 300 and 350. The universities in Nairobi are only providing about 40 to 50,000 beds.
What is the alternative right now for students?
They commute very long distances. You can see around there these kind of like huts that get put together, and then the students have to live in those types of conditions. I mean, it's if they just choose to live in the vicinity of their school. Otherwise, if you're not able to afford it, you're having to endure like 1.5 hour to 2 hour commutes. And our investment strategy specifies that the target university has to be within a 2.5 kilometer radius, so that it's essentially walking distance. There's a number of high-class education institutions outside of Nairobi as well, but Kenya has for a while been considered, I think, the potential, let's say, of fulfilling the role of the education hub for East Africa, which is, comprised of Tanzania, Uganda, Rwanda. Kenya has that aspirational element. International students are going to be coming over increasingly. I mean, if you look at the median age of Kenya is 18. 75% of the population is less than 35. The three bottom bars are actually the largest, and they're from 0 to 14. This is essentially that is going to be migrating into your customer segment over the next 5-10 years. There is projected to be a growth in household incomes ranging between 3 and 4%.
The median household income in 2005 in Kenya was $500, and now it's $2,000. So it's a 4x in the past 17 years.
And That housing gap is something that government, even the new one that's come in, has identified as a key focus area for their agenda. We don't think that student accommodation is the be all and the end all. There's a lot more housing that needs to be provided, and we're more than happy to be a part of that.
Is there like a subsidized component here, or is the whole capital stack private?
We don't have a subsidy currently. We are exploring a few initiatives, given that we are providing affordable housing. As of now, it's all been private capital. We have identified a number of micro locations, which is where the universities, like the cluster of universities, is located. Where to we have 7 micro locations for Kejani. I think we have 8 micro locations, and based on our research, we have identified what the addressable market demand is for those specific micro locations. So that 110,000 number that I gave you has been further broken down by the micro locations, right? So then what we do is we say, okay, this area, the addressable market is, let's say, 10,000. We're the only institutional provider of purpose-built student accommodations. We don't take for granted that we'll be the only ones forever. We do expect that others will join the fold. And so what we say is that when we look at our investment decisions, it's with the aim of capturing 35% of the market so that we still have a market leading position. We might not capture the 100% of the market, but at least market leading position. You say 35% of that, what does that equal? And then you see what the potential, you can build for any single project. So if you're able to build 50% of the addressable market by a single project, then you know that you can build 2 projects to capture that 35%. Right now, what you're seeing is this foray into individual markets. The next phase of growth would be to say, okay, there are certain markets where there's more growth, more demand. So let's add another asset in those locations where we already have something. Or this is only for Nairobi. Let's look at, outside of Nairobi. There are a number of great education institutions outside of Nairobi as well. Why don't we service them? Because that's the calls that we keep on getting. There are a number of universities that are like, why aren't you doing something for us? Just because we're not in Nairobi doesn't mean that we don't have the demand.
All right, so we're going to take a deep dive into the financing strategies at Acorn over the past few years, starting with Epoch 1, which is green financing paired with private equity, and then sort of Epoch 2, which is this REITs stage, the real estate investment trusts, broken out into 2 different types of REITs, the D-REIT and the I-REIT. The green bond financing was actually like how you guys started, right?
Yeah, exactly. That was the first foray into the capital markets. The origin was the development of the need to develop these student accommodation properties in order to be able to scale up. Private equity funding can only take you so far. You needed to access a wider base of capital, and that's what the green bond enabled us to do. The green bond financed 8 projects. The thing to note is that the green bond is essentially a debt instrument. Any project is developed with a combination of equity and debt. You can get debt from banks. In our case, as far as the green bond was concerned, we got the debt provided through this green bond issuance. The green bond was sized at $55 million. It was raised in 2 tranches. The loan to cost ratio was 65%.
And then the other 35% pre-REITs.
It was the parent company that was providing. At that time, it was on the parent company's balance sheet. So the 35% equity that was required was being provided by Acorn Holdings.
And this private equity partner, Helios, that you mentioned earlier, was how big of a partner in Acorn Holdings at that time?
They're 50% investor. Their investment has obviously come in through the parent company. The parent company then has established individual special purpose vehicles to undertake individual project developments. But those project developments then were by the holding company at that time. It was extremely successful, the first green bond in Africa. It has also received investments from key continental, local institutions, as you can see. Well, that's what we've highlighted in that top banner there. We've got Garantco providing a 50% guarantee towards the principal and interest, which is part of the Private Infrastructure Development Group, which is a large development finance organization headquartered out of the UK. We're one of their few housing investments. So otherwise, they primarily focus on infrastructure developments. They've done highway, road development, utilities. There's a full gamut. I think housing is a very small part of it, and it was definitely pioneering. The first green bond issuance It's the first listed green bond in Kenya, first to be cross-listed on the LSE. It's won a number of awards. So the first tranche was launched in November 2019, and then it was upsized last year in August 2021. The second tranche was oversubscribed by 46%. The availability period goes on for November 2024, so 5 years. We refer to it as a medium-term note. And during that time, we paid all interest payments that were due. We've not defaulted once. We've also been able to repay some of the capital by exiting one of the developments, which is called Kwetu Wilson View, into the Acorn I-REIT. We are in the process of operationalizing two more projects. One of them is going to be the first Kejani project in our portfolio. So it's had a lot of milestones. There are still projects that are part of the green bond portfolio, but they are now a part of the D-REIT as they're moving towards completion. When these projects were transferred to the D-REIT, at that point, the equity has been provided by the unit holders of the D-REIT. Of course, our organization structure evolved, and now what you find is that all these assets are part of the two REITs that we established. So that the pitch always was that this was a segue into the establishment of the REITs, and the REITs were the ones that would provide, or the I-REIT specifically would be the one that would provide that takeout mechanism, thereby having that repayment mechanism.
Before moving from, I guess, Epoch 1, the green bond program, to this second period of financing under the REIT program, just want to reflect back on the green bond program. This is really trying to steer private investors or developers towards building to this green standard.
Unfortunately, I don't think it's as broadly taken up as one would like. For us at Acorn, sustainability and the ESG movement is very much a core part of our DNA. We very much believe in being responsible citizens, and so we have built our developments to a substantially green standard that has received its recognition through IFC Edge. The reason we like IFC Edge, there's obviously others like LEED and BREEAM, but IFC Edge seems to be a little bit more aligned with the type of developments that you get in the continent. That was the starting point as far as certification was concerned. We've been recognized and taken part in a number of certification programs, whether it's for the REITs, whether it's for the green bond. The green bond themselves were also certified by the Climate Bonds Initiative. GRESB is a global certification program for the REITs. EcoVadis is a wider sustainability certification for Acorn Holdings. Anyone coming in as any form of investor in the Acorn ecosphere is going to be confident that they are investing in green, sustainable investment opportunity.
Are there funding sources out there that look, you have to have a green component to this, otherwise we can't invest?
I don't think we've really come across someone saying that you have to get this and therefore we will invest. It's more that we have done this and that has opened up for us a wider spectrum of investors, because particularly if you want to tap into global capital, but even here in Kenya, it's being put as a criteria for investment that it has to be a sustainable investment option or opportunity. We have a number of relationships with development finance institutions, not just kind of World Bank stroke IFC, but others as well. And that's how we're able to tap into a wide base of investors. Part of their role is to crowd in other investors to help fuel your growth. So yes, there is an advantage to it for sure.
Saving the world's great. But are there financial, advantages of building to this kind of green certification?
The buildings are IFC Edge certified. There are embedded energy savings that we can benefit from by developing in a certain way, by developing green. And yeah, we do pass on some costs, but to the extent if we're able to curb those costs, it's of benefit to investors, which will eventually equate to us facing better demand. We piloted a program for solar energy in one of our buildings. And now, as a result of that pilot, now we intend to implement it across the board, across all our properties.
Reflecting on the green bond program, what have been sort of some of the lessons learned there?
Green bond was only one part of the journey, and the availability of capital is extremely important, given the growth that we have targeted and the scope of the business model that is there. Without the green bond, we are very clear that the REITs wouldn't have happened. It was all about just building that track record, and building that confidence. The green bond got us out there as an issuer in the capital markets.
Great. Well, now we're going to move from the green bond financing to this new period that you're currently in, the real estate investment trust financing.
So let me kind of take a step back on the REITs themselves. So Kenya's regulations are quite unique in that they allow for something called a D-REIT, a development REIT. Globally, when we speak about REITs, that's what we refer to out here as an income REIT. The REIT holds operational, steady state, rent generating properties.
Yeah.
And that's how you get the tax advantages and so forth.
REITs are the ideal investment vehicle for sourcing permanent capital to scale up business models centered around rental housing. They are tax efficient structures and also enable access to the capital markets.
Kenya, in recognition of the housing gap that is there, established something called a D-REIT, a development REIT, which is like a development private equity fund, except it has the layering of a REIT so that it gives you the advantages of a REIT. So it would spur on more development. That for the income REIT, we have that similar regulation where you have to pay out every year a minimum of 80% of distributable income as a dividend, right? Yeah. So that is very much similar. In the case of the D-REIT, because it's like a development fund, the payout is a little bit more choppy, so to speak. Essentially, what we've created is like this virtuous self-financing cycle. The D-REIT is the one that buys land, constructs a property, and then once it becomes operationalized, it is available or eligible for acquisition by the income REIT. Acquires from the D-REIT, therefore it gets its scale because it knows that it has a ready-made supplier of new assets and it's able to scale up. It knows it can scale up over time. And the I-REIT, from the proceeds that it pays to the D-REIT for acquiring an asset, a developed asset, an operational asset, the D-REIT can then proceed to develop more. Under construction, there's right now 2 projects, but we have 4 new projects that are going to be breaking ground in the next month. From site acquisition to kind of construction completion, typically is a 27 to 30 months.
When you're going and doing an acquisition of a project, you already know what the exit price is going to be for the I-REIT?
We have a kind of a full-fledged governance structure and an investment process for determining the pricing. You have to do it on an arm's length basis. So there's certain mechanisms. We have independent valuers for both sides. We have investment committees for both REITs. So essentially, kind of the investment committees, take on board the information that is provided to them from multiple service providers, are able to come to a mutual understanding on the transaction value. And that's how we proceed. The way we set things up is that actually anyone who's coming in as an investor, say the institutional investors, they invest in both the D-REIT and the I-REIT at the same time.
Oh, so they get a little bit of a value add portfolio hedge.
Yeah, exactly. So it behooves us to, like you said, you're not kind of favoring one fund over the other.
What is that what's like the dividend yield, or what is that kind of typical return on those 2 different shares of the I-REIT and the D-REIT?
So on a blended basis, because it's a blended offering, the 2 REITs offer a long-term return of 18%.
As a risk premium over the Kenya chilling bond market, or I guess I'm thinking in terms of the US, you're looking at that as a premium over a 10-year investment instead of into a REIT, you're doing a treasury. So what is that in relationship to the treasury rate?
You're spot on. So our biggest competitor, or the competitor for any capital markets security in this region, I would say, is government securities, because government securities are offering anywhere around between 12 and 13%.
A 5% risk premium on the government currency risk.
I-REIT is offering 11%.
I-REIT's lower than the chilling, the 10-year.
And that's why Yeah, because like if you look at the yield, the cash yield on real estate in Kenya ranges from, let's say, around 6 to 10%. On top of that, you have a capital appreciation element. So that's how, in the case of the I-REIT, you get a total return projection of 11%, right? But that is a common struggle that markets like here in Africa face, that government securities are your number one competitor because they offer such fantastic perceived risk-free rate return. That's what you have to try and offer something compelling to investors with. So that's why we also had to offer that blended return, because you had to complement the stability, the steadiness of the I-REIT dividend with something a little bit more punchy, which is what the D-REIT offers. The other piece of innovation that we've done, and that's what you see out here in this chart, you see that there's a pink box on the right-hand side where we refer to retail. Typically, capital markets is the playground of institutional and sophisticated high net worth individuals in a market like Kenya. But we've always felt that the real potential lies with the everyday Joe, right? Which is what, if you look at developed markets, it's by bringing in retail investors that they've been able to actually fuel their growth, right? We've actually established an aggregator platform for retail investors, and that enables them to access, for now, the I-REIT, because that was a bit more safe, a bit more stable, provide them the return they would find attractive. They don't get access to the government bonds. So for them, something like an 11% return is actually very attractive.
Who are the primary holders of the D-REIT?
It's the institutional investors and high net worth individuals, what are classified as sophisticated investors. The D-REIT available for retail investors. So they're unlisted securities listed on an OTC platform set up by the Nairobi Securities Exchange. So they are tradable, but it's an unlisted security. One thing that we've learned is the importance of building credibility. For us from the get-go, we've been very focused on providing investors with the adequate level of transparency so that they know what they've invested in and they know what we're doing even afterwards. So we do quarterly investor briefings, which, I would say we're one of the few organizations to do that. We're very keen to share knowledge, share what we do. And I think that has held us in good stead. And that's why you've seen kind of a steady increase in investors in the REITs. When we crossed the first year, we were already at 30 investors as at the end of 2021, and we'd raised about 3 billion shillings, this 3.5 billion shillings, and this number has only grown since then. We've raised over $40 million. So we've had kind of significant growth. We've accessed significant capital, and it's all on the back of just being credible issuers, people that, or an organization that investors can trust. Or the mission is about providing affordable, secure rental housing, and within that, student housing is just the beginning. We've charted down at the bottom at the x-axis the different product offerings across a person's life cycle. The next foray is going to be into young professional. That's something that we're working on for launch next year. Then we'll do starter homes for young families, young couples, multi-families as those families grow, and then moving into empty nesters and retirement. It's all greenfield. It's all uncharted territory. We can do other cities within the country. And then the Z-axis is where we branch across other countries in East Africa. So the potential is massive for what we're doing, and that's what we're excited about.
Great. Well, Raghav, thank you so much for your time.
Fantastic. Thanks, Charlie. Nice speaking to you.